Yeah, I think there's a positive surprise in the start of the year. I think as we come into the year, we expected to see a response in pricing around the retail business. I think what's surprised most observers is we've seen a rebound in commercial as well. I think we expect to see that continue through the course of the year. So I think we'll see good growth in the P&C business this year.
Look, we know that higher interest rates, higher prices, it's a bit of a boom time for your sector. As Jeff and I and Karen were discussing off air, you know, it shakes out some of the tourists in the sector as well, looking for extra returns as well. But in terms of interest rates, they look like they're peaking globally, or, I mean, we think and on the insurance front as well, a big part of the inflation front. Does that have ramifications, though, for pricing going forward, if indeed we do see a reversal of the interest rates in the States and elsewhere?
So I think maybe on the boom time thing, there's a reason why we're getting this additional price, and that's because we're seeing additional claims. I mean, margins are definitely expanding and maybe expanding quicker than we thought, but there's a driver out there, which is that continued and persistent high level of claims driven by inflation. On the interest rate topic, I mean, you're absolutely right. So there's an interest rate function in the pricing, and obviously with interest rates at higher levels, in theory, you could charge less, but the industry is generally charging more to compensate for the inflation topic. So we need to be careful if we see interest rates roll over, that we're pretty active, either on addressing the price or moving the capital to the places where we get the best returns. But we need to be particularly careful as we come to this peak interest rate point.
George, you mentioned the increase in claims. Could you talk a little bit about claims inflation and what the implications are of that for the rest of the year?
Yeah, so if you look at the business last year, I mean, you saw it particularly in retail motor, especially in Europe. So it wasn't a great year for retail insurance businesses in Europe. We've seen the market start to respond. So if you look across places like UK, Germany, Switzerland, the key European insurance markets that we're familiar with, you start to see a pretty significant price reaction. So I think as we go through the course of this year, you'll see an improving environment for retail. Commercial had a much stronger run-up. I mean, pre-pandemic, pandemic boosted it even further. We've seen the pricing environment, particularly around property, continue to move up very strongly. And again, that's inflation-driven. But I mean, margins in commercial were already very high. We've driven them slightly higher as we enter this year. I think we'll see that continue through the course of the year. But if you look at the different dynamics in the two businesses, I think retail is the one that will come more strongly, certainly as we go through the end of this year into 2024.
George, I'm just wondering whether there's a grey swan event coming commercial. Everybody's talking about the problems in the commercial real estate market, that this structural change has been one big issue for office blocks, for instance, shopping centres, the interest rate story, the macro story on top of that. And there is a feeling that there needs to be a large-scale revaluation of the value in the commercial property sector. What does that mean on the insurance side if that happens?
Yeah, so I think it's an asset side issue, I think, for insurers rather than the underwriting side. I don't expect it to have a big impact from, say, a claim viewpoint. I think if you looked at a number of European insurance companies, including us, we already took marks on the portfolio at the end of last year. If I look at how we invest, it's mainly a life business topic. So it's typically an asset used to try and generate the yields required to cover some of the commitments on life. Given that we're not heavily invested or we don't write significant amounts of guarantee product, there's no big driver for us to be a very significant real estate investor. And if you look at our portfolio today, I mean, we're generally more exposed on the retail side. We've got a concentration where we still have large life businesses, places like Germany, Switzerland, tends to be retail rather than commercial. So I don't think we're as exposed to the issue, but I think you generally saw the industry start to step up to the issue at the end of last year and take some marks already, even if there may be still some to come.